Guy Johnson, Thursday morning. Tom Mackenzie's here, Valerie Tytel's here. We're an hour away from the opening trade. What do you need to know? Traders very much starting to hold their breath ahead of critical payroll data. That's Friday. The bond market stabilising, gold dropping a little. After the big reversal in long-dated gilts yesterday, the Bank of England Governor Andrew Bailey downplaying the significance of this week's long-end sell-off. And Chinese stocks dropping sharply as regulators in Beijing look to cool market speculation, Val.
The bond market rally is over, maybe just for now. Those 10-year Treasury yields are trading lower on the week now after that bond rally of yesterday on the week Gilts data. We're trading slightly green when it comes to the equity picture. S&P futures and Eurostoxx 50 futures just holding on to slight gains. The dollar just slightly stronger on the session. We have euro dollar at 116.50. The countdown to the opening trade starts right now.
Thursday morning, good morning. Valerie thinks that the big sell-off that we've seen in the bond market is now over. It's done, it's dusted, we can move on, we can talk about something else. Equity markets, yeah, they can focus on, well, something else, not treasuries. Anyway, that's the story this morning, isn't it?
I'm just telling you what the market is telling me, all
okay.
right? We're below 490 on the 30-year yield after coming a whisker away from 5% yesterday. It was all down to that weak Jolts data. I know you don't like the Jolts data, you don't trust it.
It's a bit backward-looking.
But it did show a decent rise in layoffs, especially in the construction sector, which some say is a leading indicator for economic activity. You combine that with the Fed's beige book that showed economic activity essentially stalling in the previous month, and this is playing right into Waller's hands.
The beige book has shown that the economy's been stalling for months now. The US economy's looked just fine when the beige book has looked terrible. So I think we can park that one.
Well, now we're starting to believe it now that we're seeing more evidence of labor demand cooling, and into Waller's mind, once it begins cooling,
Tom's going to decide.
Cool
Tom's going to figure this one out.
I'm going to lean in behind Val, because look, the auctions as well tell the story, right? The UK auction was well received. The 30-year auction in Japan was well received after yields on the 30-year hit that record on Wednesday. The 10s and the 30s well received in Japan, and then the gilt markets as well. Italy, the sovereign debt sales there have been well received. So investors are stepping in and they're buying at the long end. They want to be locking in these levels. A question around Fed independence, which brings us on to the Myron.
The Myron
hearing.
says it's Myron. She's in DC right now. Apparently it's Myron.
100 basis points, more than 100 basis points priced in between now and April of next year for the Federal Reserve. How much of that is pricing in a less independent Fed at this point?
So I think probably some, and I think it's the less independent Fed that the long end of the bond market is definitely going to be paying attention to, and I think a lot of people are. But I'm going to carry on talking for a minute. But I think the payrolls number is interesting.
Yeah.
Before we get to that, and I think the Myron testimony today, I think he's just going to play it cool. Why wouldn't you? You want to get confirmed. I don't know what he's going to do after this short-term interlude at the Fed. We'll get to that a little bit later. But the payrolls number, I think, is fascinating. Standard Chartered is talking about you get north of 130 on payrolls. You basically take the 25 off the table for September.
But on the flip side.
But on the flip side, if you get less than 40, you basically start talking about 50.
Yeah, and you get a weak payroll number, and this whole chat about Fed independence doesn't matter anymore because they'll be vindicated in their cutting activity now that we've seen this labor market weakening. Now, we have to also talk about the UK when it comes to all of this.
Let's talk about the UK.
Surprising rally in the 30-year
Did you see the move
gilts
yesterday? We talked about it here on the show.
Yeah.
It was the focus yesterday morning that it's a storm in a teacup. There's a buying opportunity. There's a great opportunity in long end gilts, which I think was proved throughout the rest of that was an epic rally that we saw in the gilt market yesterday. But there was a couple of comments that came out of the Bank of England testimony that we saw yesterday that really stood out to me. One of which was Bailey basically saying, why is everybody worrying about the back end of the bond market? It has almost no relevance to the UK in terms of the way that the economy functions. So I think that's an important story just to focus on. But I thought Claire Lombardelli's comments about the fact that she thought neutral could be 4%, which means we're basically
in that range, at the top end of the range, up to 4%.
Which means we're basically done. Bailey was downplaying November. So UK rate cuts to assist the economy are not going to be there at a time when they're talking about a budget which is going to be really late now, that could be really quite growth negative because taxes are going
government
up.
Solvency in the UK does not look fantastic if the base rate neutral is 4%. Let's just flat out say that.
Yeah.
We need a growth in tax revenues, which means we need to generate nominal growth here in the UK, and that needs to exceed the average interest rate they pay on their debt, else the debt pile will just continue to balloon.
And that points to the challenges of the Chancellor with the budget. November the 26th, we need growth. She's consistently said that's what the fix needs to be. But to what extent does that get undermined if you raise taxes or cut spending? And to your point, just a couple of stats from Bloomberg Economics. The UK has the sixth highest debt, the fifth highest deficit, and the third highest borrowing costs of 36 advanced economies.
Sorry, there's a couple of dates in November that kind of spring to mind.
Yes, the budget is the day before U.S. Thanksgiving.
Genius.
A very illiquid day. The bond market is a half day. I mean, ahead of a fully closed U.S. session the next day around. So it could be a very illiquid session for them to announce some new groundbreaking policies.
So just be aware of that illiquidity when you think about what that budget is going to look like in terms of the positioning. A couple of other things I just want to say before we get off the European bond markets. One of which is France is still, and you wonder whether France comes back as the story in terms of the bond market next week, and we worry about that. The other thing that's beginning to percolate in my mind is look at German unemployment. German unemployment is ticking higher. Look at what's happening in the chemicals industry. German unemployment is going up and up and up. And you do wonder whether or not this kind of view that the ECB is done may not actually turn out to be true, because there's other risks out there as well. We should talk about China.
Well, is that the labour market risks are what potentially pull the ECB off the sidelines. You can't talk about Germany without talking about what's happening in Germany. And in China. And here's the disconnect, is that we've seen this run-up, of course, in stocks in China, about 33% on the CSI 300 over the last 12 months. And today they're reporting that authorities are getting a little bit nervous in terms of the pace of the run-up we've seen in terms of Chinese equities, and they're looking at putting in place measures that might try and cool that. And we're seeing a pretty brutal sell-off in Chinese stocks today.
Yeah.
And the reason I link it to Germany is because the equity market gains in China are delinked from the fundamentals. Deflation is still a problem.
Yeah.
The consumer sentiment is still underwater. The real estate crisis continues to get worse. Local governments are not paying their suppliers. The fundamentals do not underpin this market rally. It's about tech enthusiasm. Until the fundamentals change in China, you're not going to get that additional catalyst for Germany and the rest of the Eurozone.
No, it's interesting that this is really less, or it could be less about retail enthusiasm and more about institutional investors piling into chip stocks. You even see it with Bridgewater. I mean, their funds in China have absolutely exploded. Yeah. Institutional investors want exposure to the Chinese tech. They want exposure to hedge funds. And I guess now that we've seen this reaction from the Chinese government, you're seeing the wind come out of the sails of Chinese chip stocks. One of them, the biggest one, down some 15% on the session.
Yeah. One of the darlings of the tech trade.
Which has benefited a lot from the NVIDIA's H20 battle with the Chinese government.
Can you imagine that happening to NVIDIA?
That day.
That would be.
What would the S&P be down on that day?
That would be an interesting little session. BYD, though, is being hammered as well. Talking of stocks that's just an overcapacity stock.
That speaks to the fundamentals. It's the overcapacity and it's the price cutting, because consumers domestically are not prepared to pay the prices. Competition, cut prices, deflation. BYD is partly a fundamentals and a foundational story for China.
I read somewhere this morning that the insurance market represents, in totality, around a third of output from the City of London. This is a really important place that we need to be focusing our attention. Lloyd's of London, the insurance market, out with numbers this morning. Its CEO is going to be joining us very shortly. Looking forward to that conversation. Frederic Carrier, RBC's Head of Investment Strategy, is going to be joining us as well. And Roger Fisk, Burberry Communications Senior Advisor and former aide to President Obama, is going to be here to talk to us about tariffs and what's happening with trade and US politics and the Fed and, well, all the other good things that are on the agenda. What else is on the agenda?
Well, there is a lot of risk events on the agenda from both sides of the Atlantic. At 9:50 a.m., we get a monster French bond auction, 11 yards, 11 billion euros to be auctioned, mostly in the long end of the curve out of France, maybe a risk event heading into the vote of confidence on Monday for the French government. Later in the session, we do get a lot of U.S. data, ADP at 1:15, at 1:30, U.S. jobless claims, at 3 p.m., ISM services, and then later over on Capitol Hill, Stephen Miran, Trump's next Fed pick for the governor's seat, vacated by Kugler, will begin around 3 p.m. U.S. time.
OK, here's what else you need to know this morning. A tram popular with tourists in the Portuguese capital of Lisbon has derailed, killing at least 15 people. Local media say the cable that supports the tram car snapped, sending it crashing into a building. 18 other people were injured in the incident. The tram is often used by tourists for short trips on the steep streets of central Lisbon, with some 3 million journeys made each year. Banco Monte dei Paschi has paved the way for it to take control of its rival Mediobanca. That's after it broke through the minimum acceptance level it set for its plan to buy the Milan-based investment bank. Investors have tendered 38.5% of Mediobanca's shares, above the 35% threshold set by Monte Paschi to trigger an obligation for it to buy the shares. And Bloomberg has learned that Apple is planning to launch its own AI-powered web search tool next year. Sources say the company is working on a new system dubbed internally as World Knowledge Answers that will be integrated into the Siri voice assistant. The move would allow Apple to compete with OpenAI and Perplexity. They call it their own search, but it will be built, it seems, on Google's Gemini. At least that is the plan, because their own team has hemorrhaged talent. A lot of it has moved to Meta and OpenAI. So this is Apple looking for a solution, finally, to correct its catch-up around
and in some ways, this was what this ruling on Google yesterday was really about. Apple was the real winner out of this because it desperately needs this technology.
Yeah, next Tuesday on the 9th of September, they get the release of the new iPhone 17, the new suite of products that hopefully will have AI integrated into them. Maybe this is a glimpse, a hint that some of those products will have some new Siri capabilities.
And it's interesting the partnerships they look for, because on Siri they've looked to work with OpenAI. They are already working with OpenAI. On the search part, though, specifically, and this new product, it looks like they're going to be working with Gemini. I mean, that's where the conversations are. That's how deep Gemini has shipped the product to Apple. They're working through it and trying to align it to those capabilities. That probably isn't going to come through until next year. I mean, Siri is still clunky, so that update is needed.
Polite. Yep. How do we feel about a folding iPhone? Do we want one of those?
I don't think so. Can it fit in my pocket? I'm not sure. Not so sure. But I thought it was funny that this new thing that Apple is talking about is called internally World Knowledge Answers.
It's snappy, isn't it?
They've
really nailed that one down, haven't they?
The foldable phone. I love the fact we're talking about Apple's foldable phone. I mean, foldable phones have been out
for ages.
For ages. Like in China, it's the kind of default. You get a foldable phone.
It's the default in China.
The screens are excellent. You can watch videos.
Yeah.
You know, the interaction. And it's slim enough now and light enough in terms of the design and the product and the hardware that they're using that you can put it in your pocket and it's not too much of a challenge. No, I don't, because I'm probably locked into Apple's ecosystem or any other
somebody that isn't.
smartphone.
I think it's interesting that the Pixel phone, which came out a few days ago, has all of this already.
Yes.
All of this technology is already
AI.
in there. Has it all? Yeah, precisely. The other thing I just want to flag is Salesforce's numbers.
Down 5%.
I think is worth just spending a moment on. The Nvidia numbers weren't great. Salesforce's numbers aren't great. Are cracks beginning to appear a little bit, maybe in the AI trade?
Well, I think you got to show off that you have to show to investors that this AI investment is paying off. Yeah. And if it's not, you get punished. And we're seeing that in the Salesforce stock, down over 5% in after hours after these results.
Okay. Agent Force is their AI product, and they're saying it is really converting sales that they weren't otherwise able to convert, but the top-line numbers have disappointed. So they need to show more traction with this product and also convince investors that as an incumbent, that they're not threatened by some of the upstarts.
How many waves
quicker to move on this technology.
How many waves of kind of AI technology do we need to be before it kind of embeds itself properly in the economy? And you do wonder whether it's going to be multiple waves and whether the first wave is the one that kind of crashes on the beach and then we need something else that ultimately kind of takes us forward from there.
You're still on holiday.
If only. OK, let's move on. President Trump is asking the US Supreme Court to uphold his global tariffs, seeking review in a case that could affect trillions of dollars in trade. We'll talk about that later on in the programme. Plus, luxury car maker Porsche is dropping out of Germany's benchmark stock index, the DAX, after less than 3 years. What other stocks you need to be watching at the open? Stay with us and we're going to tell you. Up next, we're going to talk about the bond market. What a week it has been. It's not even over yet. Payrolls are coming tomorrow. Pooja Kumra, senior European and UK rate strategist at TD Bank, is going to be joining us. If you have any questions of your own for our guests, please send them to us. So the function here is IB, then you need a space, then you need a plus symbol, then you need BBTV Go. That's the function. I pointed out, it's down there at the bottom of the screen, because I read it out often and don't really pay attention to what
really
it actually
wants some
says.
IBs this morning.
IB us, pay attention, get involved. We'd love to hear from you. This is Bloomberg.
The current modestly restrictive setting of the policy rate is consistent with today's full employment labor market and core inflation nearly 1 percentage point above the Fed's 2% target. Looking ahead, I expect the labor market to gradually cool and remain near full employment, with risks tilted to the downside.
Federal Reserve Bank of St. Louis President Alberto Musalem speaking there. Val, let's get your take in terms of how the markets have adjusted.
Well, you heard from him there that the labor market risks to the labor market are tilted to the downside. We clearly saw a reaction to the weak Gilts figures yesterday. Those 30-year yields, which earlier in the session came a whisker away from 5%, are now trading south of 4.90. The Gilts data yesterday not only came weak across the headline number, but then layoffs also surprisingly high, especially in the construction sector. You combine that with the Fed's beige book, which showed little or no pickup in economic activity, and this is playing right into Fed Governor Waller's hands, the main dissenter to holding rates steady at the last Fed decision. He was on CNBC yesterday calling for multiple rate cuts in the month ahead and warning that when the labor market starts to weaken, it starts to weaken very fast, and the Fed needs to get out ahead of it. He did also mention that when the labor market starts to weaken, it's not linear, it is non-linear. He is clearly worried the labor market is flashing red and need these rate cuts. And those kind of dovish chat. We might hear more of it later. We have Stephen Myron on Capitol Hill, the Senate confirmation hearing for his Fed chair seat, where he's taking over Kugler's governor's seat. So perhaps we'll get some more discussion around how Trump's policies are deflationary in nature. But this has also been helping out the gilt market guy unchanged on the week after all that faff yesterday.
We'll come back to that in just a minute. So Chris, what does he want the job at the Fed?
Of course he does. Don't you?
I just love it. Be great. Not sure I'm on the list, though there are many people that are on the list. 11, apparently. Anyway, let's talk about all of this. Pooja Kumra, Senior European and UK Rate Strategist from TD Bank, joining us around the table. Good morning.
Good morning.
Let's start with the UK. As Val just pointed out, massive round trip at the 30-year. Is this just noise? Can I ignore this? Is there any significance here? Is the bond market sell-off in gilts, particularly at the long end, now over?
It's basically a new reality. We've just moved the date from now to closer to November 26, just because of the change in the date from the Chancellor. I don't think the sell-off is over. We are still dealing with the same issues. Who fills the fiscal buffers and how do they come from? But for me, even the initial move, I don't think we had any new information. These were the exact numbers we were dealing from day one of the March budget.
Claire Lombardelli thinks that neutral rate could be around 4%. If that's true, what are the implications for the whole of the bond market?
I think in that case, definitely we will see 30 years selling off even more, if you're thinking about your base rate being 4%. But I don't think anyone believes, if you look at the growth rates, which are still sub-zero, you cannot have a neutral rate that's so high. Even if you look at productivity and inflation, our productivity, even in a really positive scenario, if we reach the 1% level, inflation at 2%, according to BOE's target, I think the neutral rate still is looking around 3%. I think 4% is something we are pushing it a bit too much for this economy.
OK, so 4% is too much of a stretch. Pooja, good morning. If we look at the divergence then, the picture when it comes to the Fed versus the BOE into 2026, with a Fed that's cutting aggressively on market pricing and on expectations right now, and a BOE that on the communication yesterday during that hearing is possibly going to be on hold until potentially the middle of next year. What does that divergence mean for UK assets then, if that is the story that emerges next year?
I think this is what we have been trading, right? When you look at 10-year gilts versus USDs, they have been widening. I mean, for me, it's like what happened to the de-dollarization trade that we were talking about in April, May, and clearly has not been. I don't think we have seen it in UK market or even in bond market. If you think about 10-year bonds are still at 270. I think no matter what, any non-domestic investor wants some political sanity in the country, and right now with this kind of fiscal number that we keep chasing, we are going to have this issue ahead of every budget. So I think the idea of actually reducing from 2 budgets to 1 budget is really important for this government as well.
So to the US and the non-farm payrolls on Friday, how asymmetric are the risks around that number?
I think clearly for a higher number, this is something that we were even talking about, that it's going to be more risky for the markets. I think September is definitely locked in. I mean, we've got very clear-cut message. And when it comes to non-farm payrolls, we've also got this message, the fact that they are looking at all measures and not just one measure. And so far, we have seen that slow down, whether it's Jolts, initial claims. And I think that's what, at this stage, it's really clear that the Fed does not want to mess around with the labor market. And I think September is done. I think what comes into question is October, whether they will follow a quarterly pattern or whether they have much evidence to follow a consecutive pattern.
Well, Pooja, with that in mind, that you think September is a done deal no matter what the data shows us, if we do get more weak data, let's say we also have inflation coming in weak next week as well, do you think there'll be speculation that there'll be an even larger rate cut in September, or is that something that's not necessarily on your radar?
I think there should be more speculation. We've seen this going through in various phases of data. Even the last non-farm payroll market started to think about above 25. So definitely there is a risk at this stage that they do go above. And we know that even last year, Fed followed the risk management technique of doing 50 basis points, right? So I think that way everyone wants to be long the front end because they know the Fed will be ready to cut if they see significant weakness in the front end. Sadly, we don't have that kind of data in UK to support that 50.
I do want to ask your thoughts on France. That's another risk event on the horizon with the vote of confidence happening on Monday. We have a big French auction later this morning. What is your thoughts around the risk of OATs? Are we headed for another blip in the French market, or could we actually see something of greater magnitude happen this time around?
I mean, again, as with the UK situation, I think we all knew that this was coming. But the issue with France is whether we have a new PM or whether we have another election, we'll be in the same boat. So for me right now, more than Bunds versus OAT actually further widening, the risk is that we stay there for the next 6 months because we'll have to find a new prime minister, or we go through elections. We need to find a new budget. We need to get that improved.
And they haven't passed a budget in almost 2 years now.
Yes, so that, I mean, that's what the issue right
France
now
is still there, by the way. Just kind of like.
So, I mean, to be honest, it has been something that we knew it's coming, but everyone was trying to ignore it. But it's just flaring up. And I think right now, the way markets want to trade, yields can pick up even with no selling, with illiquidity in the OAT curve.
Are we done with inflation? Are we worried about inflation anymore? I find it fascinating. There's a note out this morning from Deutsche Bank. I'm quoting here, perhaps the most interesting data of today will be prices paid components in the US ISM services release. Last month it was at 69.9, and they extrapolate here, and there's a lot of kind of caveats around it. If you extrapolate 69.9, and I think the survey number this time is 69.5, you get 5% US inflation over the next few months. So that's the extrapolate. Now, they're not saying that's actually the reality because this is very prone to being quite bumpy. Yes. But are we okay to ignore inflation? Is the labour market really only the single needle in the compass now?
I don't think we will be ignoring inflation. We have seen components of US inflation moving higher, right? Whether it was toys, furniture, and in fact, we have seen even ECB talking about furniture inflation and toy inflation. So it's really not over yet. I think I don't want to sound repetitive, but what we hear from central bank is where are more risk, and that's where they are turning towards. Yep. Because I don't think anyone wants to be responsible for a recession. They managed to create a soft landing so far. And so they are more sensitive to something that can get downside through growth.
The other piece that came out from the Fed Beige Book was higher prices and a weaker consumer. Pooja Kumbra, thank you very much indeed for the analysis across these markets. Think about fixed income, of course, the non-farm payrolls on Friday and pushing forward into 2026 for these central banks. Pooja Kumbra, TD Bank Senior European and UK Rate Strategist. Coming up, we're going to speak to Patrick Tiernan in his first interview with us as CEO of Lloyd's of London, the world's leading insurance and reinsurance marketplace. That is coming up. This is Bloomberg. We are 30 minutes then from the start of the opening trade this Thursday. European futures essentially flat after modest gains yesterday. Gains of around 0.6%. Some upside coming through on Wall Street as well. FTSE 100 futures flat, looking for the next catalyst. Arguably for these markets, it's going to be non-farm payrolls dropping, of course, tomorrow out of the US. Futures over in France, as we look ahead, of course, to that political event of next week and that vote of no confidence, currently pointing a little lower by 0.1%. Let's check in on bonds. There is more stability there.
More stability.
In the session today,
and good news, we are seeing a slight rally to start the session. German 10-year yields are down by 1 basis point. Tracking the move in Treasuries, we're at 4.20 on the 10-year yield when it comes to U.S. Treasuries. Does seem to be some calm in the water there. We do have a French auction, though, at 9:50 UK time, so watch out for that risk event ahead of, Tom, as you mentioned, the vote of confidence for the French government on Monday. But joining us now to discuss these markets is our Markets Live executive editor, Mark Cudmore. Mark, I want to start with a question that is from our previous guest, Pooja Kumar, over at TD Bank. She was saying that there's really nothing that payrolls or inflation could give us next week that would put this Fed cut in doubt in September. Do you agree with that?
I don't agree with that. I know that actually there are many people in markets who are in that camp. I would say it's the majority view. But I think there is still a risk of 50 basis points, and I still think there's a risk of nothing. I think the non-farm payrolls will probably be less a reaction than CPI, because if it's strong, cynical people in the market will say, well, because it's the new BLS chief and that's they wanted strong numbers and therefore they've got strong numbers, they'll look through it. They'll know that the Fed reaction function is going to be dovish. So I think it'll need to be monster strong for that to have a big impact on yields. And that's why I think, in fact, there's an asymmetric reaction function from non-farm payrolls to see yields go lower, because of its very disappointing data, despite the change in the BLS chief. Well, that would be a real downside for yields and might see 50 basis points priced. And then the next one is CPI. I think if CPI comes very strong, for example, if you see headline CPI at 3.1% and core is also a little bit above expectations, then I think, you know what, suddenly people go, how can the Fed possibly cut? And it puts that 25 basis points in doubt. So, yeah, I still think that the Fed meeting is absolutely in play. I think that, you know, the natural language model on the Fed at Jackson Hole, and Powell's speech at Jackson Hole, suggested that they, you know, it wasn't as dovish as originally interpreted. The fact that he was leaving open, he was validating pricing for a 25 basis points cut, but he wasn't confirming it'll definitely happen. So it's all still in play for the data over the next couple of weeks.
Let me ask another similar question, Mark. Gilts have completely round-tripped at the long end. Massive rally yesterday. Is that crisis over?
Like, as we talked about yesterday, you know, this move was getting quite extreme, given that there was no fresh catalyst in the short term. You know, and we talked about how it was probably going to burn out at some point soon. I don't think that the longer term crisis, no, has not gone away at all. I think the UK is in a tough spot around its economy and the fiscal situation. But that's a story that's going to play out over many, many months. So the longer term crisis, no, is not solved. But short term, it does look like it's going to be behind us. I think the next big catalyst for bond markets is probably from France.
Mark, I want to switch the focus to equities, and particularly the stock story over in China with the news today around some of the efforts by regulators there. Can they engineer a steady, a slow bull market for Chinese equities?
No, they can't. I don't think that's how it works. I think, you know, you either kind of temporarily set it back and you kind of dash enthusiasm for a bit and maybe you clean out some weak hands and you get a bit of retracement, but then it'll carry on again. I think it's very, very hard for policy makers to guide a smooth bull market. Either you've got animal spirits and people are excited and the market gets completely carried away, or those animal spirits are dashed and you get an overreaction to the downside. As you know, I'm structurally very bullish the China-Hong Kong story long-term. But sure, we're due a pullback, and now you've got a reason from the government, and this pullback can go further, but people will look to buy it, and validly so.
OK, well, the pullback is there on the benchmark CSI 300, currently down 2.8%. Bloomberg Markets Live executive editor Mark Cudmore, thank you. Remember, of course, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal.
So I saw a number earlier that suggests that insurance is a third of the City of London in terms of the business. So our next conversation really matters. Lloyd's of London, the insurance market, out with numbers this morning. We'll get onto those figures in just a second. But before we do that, let me introduce the new CEO, Patrick Tiernan. Good morning. Nice to see you. Welcome. We hope this is the first of many conversations we have with you. Doesn't necessarily mean I'm going to be nice, but we'll have that conversation. Okay. The combined ratio is down to what looks like a kind of more normal number. I'm going to put my glasses on. We were at 83.7. If it's the further away it is below 100, the better the number is. We're back to kind of 92.5. Is this a normal set of numbers that you're delivering here today? Is this kind of in line with expectations and guides us towards the kind of expectation you had for the full year?
Yes. So I think these are solid numbers. I think when we see the three headline numbers of growth, of profit, and of capital, we've got very sensible growth, solid profits, and very strong capital. I think that return to normalization is driven by more normal major losses, so more normal cat losses. And that actually happened quite early in the year. That happened with the California wildfires back in January.
In terms of things that therefore could cause volatility in the second half, obviously a catastrophe would do that.
Yes.
So that's pretty hard to prejudge, and that's the nature of the business. What about the bond market turbulence you're seeing at the moment? Obviously, you have big investment returns as well, and that's a huge kind of factor. We're seeing huge amounts of turbulence going on. Is that something? How much attention do you pay to that in terms of how you are going to deliver numbers for the full year?
Yeah, quite a lot of attention. So I think if we look at the first year numbers, the investment return at £3.2 billion is actually showing the conservative nature of the portfolio that the players in Lloyd's have. So it's both sides of the balance sheet. For us, we need both sides to work. We need the liability side to work, which is the insurance profits, and we need the investment side to work as well. So right now, I think we feel pretty comfortable in terms of how the portfolio is placed. It's placed for conservatism, and it's paying well in the first half of the year. So no update from us today. We're affirming our guidance of a 4% return on the assets for the full year.
Patrick, I want to bring our viewers' attention to an FT article out about Lloyd's earlier this morning saying that you're planning to overhaul employees' performance management, also saying that around 3,000 people are deemed to be put at risk of dismissal. Anything to say on that report?
Well, I think there's quite often confusion between Lloyd's and Lloyd's of London. So Lloyd's Bank have those headlines. So Lloyd's of London, the marketplace, we don't have any announcements on that.
That's the bank. Big horse.
In terms of look, the investment part of the business and how you're focusing on growing that in the kind of quarters ahead, the priorities for you, because the performance has come through. On the numbers today, the performance is relatively strong on the investment return, 3.2 billion pounds. You've recently come into this role. What for you is the priority when it comes to that segment, that unit of the business?
Well, I think for us, it's about driving the pipeline, driving demand, because as a marketplace in London, we're actually competing with other insurance markets around the world. And I think when I look at the outlook is extremely positive across a number of vectors. So M&A interest into the Lloyd's market is very strong. We've had a couple of deals announced over the last couple of days. Capital coming into the market through what we call our London Bridge 2, which is our ILS bridge. That's actually very strong as well, £2.5 billion. And then new entrants, where we're competing to have businesses set up on our platform. Again, very strong. So we're actually pretty excited about the pipeline. We got to think about both sides because we're in the risk business. So the risk vectors and the risk contours are all pointing up. We have higher tempo of risk, more interconnectivity. So today, risks are more ricocheting rather than rippling. So we got to be ready to actually take that volatility. And how we think about that is when the demand needs to be increased for insurance products, because there is a correlation between the penetration of insurance and growth of the economy. So if we can make that argument, we can make that case, we see demand going up for insurance.
One new growth driver potentially is some of the structures around AI risks. And we've seen this being built out by some of those at Lloyd's of London in terms of trying to ensure that corporates and companies, enterprise, have systems in place and insurance products in place that can shelter them if those AI products go wrong. What is the potential growth? What is the potential scale and size of that and scope of that market?
Well, it's probably exponential. I mean, as AI becomes much more ubiquitous in the economy, like we had cyber in the past, there's probably a huge amount of demand coming.
And are you seeing that demand from corporate? Are they turning around and saying, we need these insurance products?
We are starting to see it. Right. But we actually have to think about AI across two different vectors. So for us, it's not just the growth of AI within the delivery mechanisms of service providers and manufacturers. It's also how risks change. So we've been measuring risks for 335 years, and we know how wars tend to escalate, or how, for example, life sciences, where there's humans involved in the testing, we know how those risks manifest today. But as we look forward, and there's much more AI in the delivery, then risks are going to change. Some are going to go down, some are going to go up. So we've got to make sure that we're prepared to understand those risk dynamics so that we can actually price the risk well and remain competitive.
There's a lot of focus on the UK government right now. There's a lot of focus on the City of London.
Yeah.
What would you say to the Chancellor right now, who is considering putting a budget together, will be putting a budget together for November, in terms of what you want to see, what you need to see to make this market, the City of London, more competitive? Because there's all kinds of talk of taxes, there's all kinds of talk of kind of the factors which may slow the economy down. What advice do you send out in your new role to the Chancellor as she starts to think about that? What do you want to take your tenure forward in terms of what you're going to see?
So I'll start by saying that we're very encouraged that the government has put specialty insurance as one of its frontier industries for the next 10 years. So being one of those 8 is very positive for us. I think we would like policies that increase demand. As we were saying a second ago, if there's a direct correlation, we can make that case between growth, which is what the government is driving for, and insurance penetration. We've got to make that case. I think the one area where I think we could have aligned interest is that proportionate regulation rather than over-regulation allows innovation to flourish and actually will bring demand for insurance into London. If you've got a proportionate regulatory system and if you've got Lloyd's of London as a market, taking that burden off businesses that are trying to grow. So I think I would be pretty net positive in terms of what the government can do to drive growth in what is, I think you sort of said it's sort of 40%, or 30%, but it's 40% of the jobs in the city.
In terms of where that growth could come from, just in terms of the sectors you're looking at, Tom was talking about AI. I noticed this morning that there's a focus on fossil fuels as well, which I think is quite interesting. Where do you think the growth in insurance is going to come from? Where do you think the sectors that you're looking at are going to be? Do you think we got over our skis too far one way on the fossil fuel side? Now, I can understand why, because obviously fossil fuels, you could argue, drive climate change, which drive insurance claims. You can, the connection's kind of there. But do you need to start over there? Can you insure fossil fuels and insure climate change at the same time? Is that something you feel that Lloyd should it be able to do the whole range of activities?
Well, yeah. Lloyd's as a marketplace, it benefits from the wisdom of crowds. So we're able to accommodate dissenting voices and different choices. So that the syndicates, the businesses that work within Lloyd's, will have different views. We'll have different views across a number of topics. I think from our perspective, where the demand will come from is where the risks are increasing. So climate change risk is increasing, and insurance products, both from a protection perspective and from the perspective of actually paying claims, is very important. So if you look at Lloyd's for the first half of the year, we've paid 14 billion of claims, an extra 1.7 billion of that to the victims of the California wildfire. But we also are working with folks in California to actually avoid the damage in the first place, the conflagration of fires. So I think we've got to use the science and the numbers to actually work very hard on the prevention side, but be there when protection is needed as well.
Patrick, it's great to see you. Thanks very much indeed for stopping by, bringing us the numbers this morning. We really appreciate it, and your thoughts on where we go from here. Patrick Tiernan, the CEO of Lloyd's of London. Thank you very much indeed. Coming up, what is back? Burberry's back. Check.
Yeah, from insurance to Burberry to luxury. This is where, of course, Guy Johnson shops for his weekend.
You've always had this view. There's no evidence to support this whatsoever.
Backed up by facts. Burberry is probably more of a Zara guy, isn't he? Probably. Burberry is back in fashion with investors. The stock set to rejoin the FTSE 100. We're going to talk about what that means for Burberry, and the other stocks to watch will be in focus as well. Stay with us. This is Bloomberg. OK, let's cross over right now to South Africa. Jen Zabasaja, our correspondent on the ground, ahead of a G20 Leaders Summit. Jen.
Yeah, Tom, good morning to you. We're actually at the B20 recommendations proposals that it's going to be happening later today. And just to give you some context, the G20 Leaders Summit happening later this year in November. Many people talking about the significance, whether or not there still is significance for a forum like G20. But what we've seen over the past few days, of course, in China and elsewhere, is that we are seeing alliances being reaffirmed. And that is what many people, especially those who are going to be on the ground here at the B20 summit, proposal summit that's happening here, are hoping for. And of course, it's important for South Africa. It's important for the global South as they put forward a number of the proposals that they are hoping actually get heard at the Leaders Summit later this year, which is why I want to bring in one of the key people who are going to be focusing in on a lot of the priorities that he says hopefully will end up in the communique that will come out later today. And that is, of course, Standard Bank Group CEO and also the B20 Finance and Infrastructure Chair. That is Sim Tshabalala standing by with me here. Sim, thank you so much for being here with me. Tom was just talking about just how significant this G20 summit potentially could be if we do see a communique actually coming later this year. We're seeing a number of geopolitical tensions, though, getting in the way of a number of financial institutions. As Africa's biggest bank, talk about how you're navigating that right now.
Jennifer, the world is complicated. It's going through a very turbulent time now. We've not seen the levels of volatility for decades. But, you know, if you go back to thousands of years of economic history, you have upswings, you have downswings, you've got turbulence, and you go back to equilibrium after all of these periods of turbulence. Our institution analyzes the environment, we analyze the geopolitics, the geoeconomics, we position our institution accordingly, and we manage for the future, looking forward over 10, 20 or 30 years.
Does this period, though, of instability potentially affect what we ultimately see from the Leaders Summit and the communique coming later this year?
It does. It makes it very, very difficult. You've got the United States, which is following a different path to what has traditionally been. We're going through a period of deglobalization from the perspective of the United States. But we believe that the United States is always going to remain inextricably intertwined with global issues and global events. We're respectfully making recommendations that we hope they will take on because the United States is going to be following South Africa. This is a long-term game, Jennifer, and you respectfully make your point, you argue for it, you give data in support thereof, and we're hoping that the authorities will follow.
One of those proposals is overhauling financial architecture, and in particular Basel reform. Talk about what you expect could actually be achieved, especially if we talk about the U.S. and taking over the G20 presidency next year.
Well, there are two different types of things happening at the same time. The one is the U.S. is no longer participating in Basel IV, for example. The EU has put the pen down. The United Kingdom has also put the pen down, subject to what will happen with the US. Everybody wants to be competitive. Other parts of the world have implemented Basel. We, as South Africa, have implemented Basel IV. So that's the one set of issues. The second one is we would like changes to the regulations such that we hold less capital for infrastructure projects on the African continent and globally. That's the second macroprudential type of changes we would be recommending.
What do you think that could actually open up then for the global South?
It could open up for Africa. We need $170 billion per annum on infrastructure. We can only raise $85 billion. Making those changes would release a vast amount of money of capital, allowing us to write more projects to close that gap of $85 billion. That's just one example.
And Sim, this week we were focusing on the SCO summit that was happening and some of the reforms for policy and development policy in particular. Will we see that from the task force that you're chairing as well? Similar recommendations?
Our recommendations are about reducing the cost of capital for the global South and emerging markets. Making it easier to move goods between countries on the African continent and in emerging markets, making it easier to build projects that are transformational, whether it be bridges, ports, data centers, and all our recommendations are calculated to make it easier to finance these transformational projects.
So similar to what we saw earlier this week, potentially?
Similar, but different, and focus very much on the African continent and emerging markets.
All right. Unfortunately, we have to leave it there, but really appreciate your time. Sim Tshabalala, Standard Bank Group CEO, joining us, and of course, chair of the Infrastructure Task Force and Finance Task Force here in Johannesburg. Val?
All right, that was Bloomberg's Jennifer Tshabalala in South Africa. Thank you so much. We're headed into the European Cash Equity Open. Let's get some stocks to watch with our Chloe Melly. Chloe?
Good morning, Valerie. Let's start by keeping an eye on Monte Paschi and Mediobanca today, because it does look like Paschi is moving closer to buying its rival this morning. It has broken through the minimum acceptance level it had set to buy Mediobanca, and if this deal does go through, then we are getting Italy's third largest bank. So we'll see how this latest update really changes this particular picture at the open this morning. Moving on to Burberry. Burberry is rejoining the FTSE 100 index after exiting last year. The massive share drop that led originally to this exit, we can see has been recovering a little bit. That is thanks to the turnaround efforts by the new CEO. And of course, this re-entry is really a boost in that recovery. Moving on to Porsche, and Porsche is exiting Germany's DAX index. Porsche has been lowering its outlook a lot this year. It's been dealing with tariff uncertainty, of course, but also low demand for electric vehicles and low demand in China. And it has been also underperforming its peer Ferrari. So we'll be getting potentially some share movement there this morning as well.
OK, our equities reporter Chloe Melly on some of the stocks to watch some of the changes around the index participants, Porsche and Burberry in focus. Burberry stock is up in the last 12 months, around 100%. So the turnaround is there for Burberry, and now they're being rewarded.
It's interesting because at the same time we've seen luxury names actually in Europe struggling of late, which so it's interesting that Burberry got to that point. I think a lot of people were surprised that it actually didn't get taken over at that stage when it was as cheap as it was. Anyway, keep an eye on that. Keep an eye on the auto sector today. BYD is going to be a big focus as you look at what's going to happen with the European names this morning. Bond market calm. Does that equal equity market calm? We're about to find out. The open is next. This is Bloomberg. Thursday morning, good morning. Does a calm bond market equal a calm equity market? I think all evidence this morning certainly points us in that direction. I'll give you Exhibit A, which is yesterday's session. Bond market not calm, not calm, not calm. Then we get this rally starting to kick in the gilt market. You see it's happening over in the States as well. The Gilts data driving that story. And as a result of which, what you do at the end of the session is get a big equity market rally. We're kind of back to where we were. Stability seems to be the order of the day, Val.
Well, stability across the futures picture as well. Looks like we back to August trading. Maybe we'll see a pickup in volumes, but Eurostoxx 50 futures up just by 1/10%. 50 100 futures trading flat, as well as the DAX trading flat on the session. There are some stocks under the hood that we have our eye on. Tom, take us through them.
Individual names to focus in on, some changes around some of the main indexes with the likes of Porsche and Burberry, different fates for each of those. Burberry re-entering the FTSE 100, that turnaround plan for the relatively new CEO appearingly to turn around, and that is a validation at least for executives at the head of Burberry, the UK luxury firm. Porsche, though, out of the DAX. Challenges, of course, around EVs and demand out of China. SAP, the read-through from Salesforce, and question marks again about the AI proposition for that business. Revenue forecast not as strong as some had expected. Maybe there will be pressure on SAP, which, of course, rivals Salesforce. So some of the individual names to keep an eye on as well. Guy?
Yeah, it could be a bit of a derivative trade in Europe this morning. Tech could be hit by the Salesforce story. Cars could be hit by the BYD story. That may be the narrative that we watch as we work our way into the European Open. But the story over the last few days has clearly been the bond market. That has caused turbulence in the equity market as well. Signs of stability in the bond market, signs of stability maybe therefore in the equity market. We're about to find out. Time for the Thursday session. The opening trade is almost upon us. We'll see how Gilts open in a moment as well. But let's give you some numbers on equities and see where we are this Thursday morning as we approach, of course, the payroll number tomorrow. That is the other thing that we're going to be watching for so carefully. FTSE 100, flat as a pancake. We'll dig into the details of that in just a moment. Obviously, we are seeing some changes there as well. Spanish market, flat as a pancake. Stock 600, flat as a pancake. Stability, maybe the order of the day. Maybe everybody is just going to start holding their breath now, waiting for that payroll data, but keep an eye on that ISM figure as well out of the United States. What's the inflationary picture out of that? What's the payroll picture out of that? You've got ADP coming up. There's a few turbulence, there's a few elements of turbulence that are still going to be on the docket today. But at the moment, it looks like equity markets are fairly calm. The CAC has yet to open. The DAX has yet to open. The SMI, with inflation kind of near zero in the Swiss economy at the moment, yet to open. So what are we seeing in the sector story? Individual stocks as well. What are we watching? Val, Tom?
Well, at least when it comes to the technology sector, it's at the top of the basket this morning. So I guess not very much swayed by the miss in the Salesforce earnings overnight out of the U.S. We have SAP trading in the green as well. At the bottom of the basket, we do have travel and leisure. It seems like EasyJet at the open, those shares are down some 4%. So that's leading the declines for the sector. Travel and leisure at the bottom of the basket. But it is fairly even when it comes to the split of the sectors in positive and negative territory this morning.
Yeah, to your point, Val, the airlines are under pressure, it seems, and so the standout in terms of the downside is travel and leisure, down around 1%. On the upside, media just up 0.5%. Tech, to your point, a little in the green as well, just up 0.4%, despite the concerns around Salesforce stateside. In terms of some of those individual names, of course, Burberry re-entering the FTSE 100. I don't print on Burberry quite yet. But in terms of the gainers, Embracer Group is up 3.6%. Dassault Aviation, so some of the industrial names are gaining as well. AP Moller-Maersk in the shipping space getting 1.7%. On the downside, you do have those airlines. Ryanair now down 2.7%. EasyJet down 3.6%. So a gauge there as we look at the bond markets opening as well, with gilts also in stable territory so far.
I just want to check what the ex-divvy list looks like this morning and make sure EasyJet's not on it. Doesn't appear to be, according to my list. It's Thursday in London, which usually means ex-dividends. It's Admiral, Antofagasta, Derwent, Kingspan, Lands, Securities and Pru. So I don't see EasyJet on that list on this morning, so I'll dig into that and find out what's going on.
Yeah, still some interesting stuff going on under the hood, though equity markets are trading pretty flat. We do have S&P 500 futures just slightly in the green, up 0.1%. But joining us now to discuss equity markets and macro more broadly is Frédéric Carrière, the head of investment strategy for the British Isles and Asia at RBC Wealth Management. Thank you for joining us this morning. What do you take of this market? I know we're back to school, first week of September. We got the big payroll print tomorrow on the horizon. Are you bullish or bearish to start this month?
Look, we've had a summer where a lot of the risks seem to have been ignored, and so the market is a bit more nervous this week. All eyes, of course, are on the figures, the non-farm payroll figures tomorrow. We expect about 64,000 new jobs, so just a little bit below consensus. We're mindful that now that the trade uncertainty has largely passed, there might be a bit more hiring, and we'll be looking very closely not only at that number, but what makes up the number. Is it mostly from the healthcare sector? How about from cyclical sectors? And that will give us a sense of the health of the US economy. And of course, we'll be looking very closely also at the revisions, given that there's a new head of the Bureau of Labor Statistics.
And we also have the inflation data for the U.S. next week as well. We had a previous guest come on. It was Pooja Kumar from TD Bank saying there's really nothing in the data this week that would sway her opinion the Fed is going to cut in September, given what Powell told us at Jackson Hole. Do you share that kind of opinion?
We're waiting for the numbers tomorrow. If they're not conclusive, then the CPI number in September will be very important. And as part of the difficulty of the macro data which is coming out at the moment is that you can interpret it both ways. So we need a bit more data to know. We do expect for sure a cut in December and probably one in September. We concede that the risk is for a September cut.
Given what's going on at the moment, equities, you could argue, are fully valued. You've certainly got multiples at very elevated levels versus historical context. You've got a bond market that seems to be quite choppy. From a kind of wealth management, investor, asset management perspective, do I just buy dips? Is that still the strategy? Just wait for a moment, take that moment. You've just seen a huge turnaround in UK long-dated bonds, for instance. You could get volatility in the equity market around some of this story. Nvidia's been fairly choppy over the last... Is that what I'm doing right now? Just waiting for a better entry point and then putting money to work? Is there a kind of bigger picture story here, or is that tactic still the way to go?
We agree that from an asset allocation point of view, it's difficult to be excited at the moment on either equities at 24 times. Yep. Earnings in the US. We are neutral, all regions. In terms of the bond market, government finances make you not want to invest heavily in bonds. Credit spreads are very tight as well. So you have to work really hard. You have to be very dynamic, focus on areas where you have very strong conviction. And if you have the right risk profile for wealth clients, perhaps liquid alternatives are an area, particularly infrastructure, where cash flows are indexed to inflation, but really high conviction and be very dynamic, very important.
OK, so you want to be dynamic. How many of your investors clients are buying gold right now? And why are they buying gold, I guess, is the other question.
So the ones who are buying gold are focused on the US dollar weakness. They want a safe haven. And we do expect that gold prices are likely to gain more, particularly if there's another macro event. So our price target is for north of 3,800 per ounce for next year. And we're getting there. It could be higher if there's more need for a safe haven.
It's interesting. Goldman Sachs, the note that they put out.
So I was going to go to.
For $4,000 is their baseline for next year. But up to $5,000 if Fed independence is undermined. If you get talk to me about Fed independence and what for you would be the trigger that says, OK, this is an undermined Federal Reserve, and then how that would change your advice to your wealth clients.
So we're looking at the developments regarding Governor Cook and whether she's replaced, by whom, and whether the Federal Reserve, the regional Federal Reserve governors, whether they are reappointed. If the hawkish ones are not reappointed, you would have a very, very dovish board, and therefore much lower interest rates than even the market expects at the moment. So the point about Fed credibility, Fed integrity is very, very important for the US dollar in particular, and that is where the gold scenario does come in.
And when it comes to the bond markets then, bringing it back to that, yield curve steepness, that trade has further to go?
We think it does. Again, going back to government finances, and markets are probably thinking ahead at inflation coming back into the system, probably from trade tariffs coming through, and that is pushing up yields.
I guess, a lot of the market action this week has been in the bond space, seems to have been settled for now. Do you still think there are risks in the horizon to higher yields? And does that in somehow change your equity market view? How are you thinking about fixed income?
So we do think there's a possibility of steeper yields, and therefore we focus on the part of the curve which is less than 5 years. And again, this idea of really strong conviction, so European AT1s, you think of steeper yield curve, that's good for the banking sector, and we think that AT1s will be very well supported.
Out of all the assets in the world, what do you think is the most underpriced right now, given your view?
Look, we have a very strong conviction about biotech stocks. For us, both from a top-down and a bottom-up perspective, they're interesting. They benefit from lower interest rates and also from a more lenient Federal Trade Commission, which will allow more M&A. And of course, Big Pharma has a pipeline issue with $350 billion worth of sales, which are vulnerable to patent expiries. They have a lot of cash on the balance sheet, and they think often that biotech stocks are part of their pipeline. So we expect more M&A activity. And from a bottom-up perspective, we expect good news on select stocks in terms of clinical data, approval, or even higher estimates of what commercialization of products might bring up.
Interestingly, in your notes, switching from biotech back to the bond markets and what's happening with gilts, you seem to be rather unconcerned about the sell-off that we've seen in the gilt markets, and that's been corrected now by the end of this week, because you say this is a government that is taking deficits seriously and is one of the few to do so. What does that mean? Are you adding gilts then in that assessment?
So we're not, but we're mindful that there's very little headroom, right? The headroom that the Chancellor set herself was just under £10 billion in order to meet her balanced budget by 29-30. Before 2022, most chancellors had a headroom of 30 billion. So the Chancellor is very vulnerable to any changes in circumstances which are outside her control. So we are mindful of that. We know, however, that the 10-year gilt issue recently was very well supported. There was strong demand. So we have, I suppose it's a nuance. We don't want to be too pessimistic. We realize there's still demand, but we are mindful that the situation is quite precarious for government finances.
Ulrike, nice to see you. Thank you very much indeed for stopping by to see us sell up September as we start the month. Looks like volatility could be on the way, but today, maybe a session of calm. Frédéric Canier, Head of Investment Strategy for the British Isles and Asia at RBC. Wealth Management. Core 6 looks a little bit like this. This is the picture that we are watching at the moment. A game of two halves. Tech actually is doing reasonably well. SML, Schneider, OK. Nestle bouncing back a little bit today after being badly beaten up earlier this week. Novo's a little soft. LVMH is a little soft. Rheinmetall is a little bit soft. But that kind of sums up the market at the moment. Basically, one side, it seems, is offsetting the other. What else are we watching? Let's find out with Chloe Mellin.
Good morning, Guy. Let's start with perhaps a surprising move for Sanofi today. The shares are down 9%, and that is despite Sanofi having an eczema drug that cleared a late-stage trial, which should have set it on course for a big win. But for some reason, the market is reacting quite negatively to what should have been quite positive news. Moving on to Heidelberg Materials over in Germany. Heidelberg makes cement and makes concrete. It's in that kind of building materials supplying space, and it was rated a new buy rating at Goldman. It is up 1% on the back of that. It's a stock that has benefited from the sentiment around infrastructure spending in Germany in particular. Moving on to another building materials stock, this time over in the UK, Grafton. Grafton this morning had really positive earnings that beat estimates. It also had a new buyback and said that performance in Ireland was particularly strong. So on the back of that, we have a positive share move with shares up 1.5% this morning. And finally, let's end on Getlink. Getlink operates in the road infrastructure space, and it was downgraded at JP Morgan, and so we can see the shares getting a little bit of a beating on the back of that. We're down 2% for Getlink.
OK, Chloe Mellin from our equity team, thank you very much indeed. We'll stay on the stock story, some specific names jumping out, particularly in the travel and leisure space, with airlines falling, Guy.
Yeah, Jet2 is the epicenter of the action this morning. Its stock is down really quite sharply. Talking about an EBIT very much at the bottom end of the range. You got an AGM statement update this morning, which is why I think it probably was off our radar this morning. But that stock is down pretty hard. They're sort of pointing as well to what they're going to do this winter. They're talking about near-term bookings as well. All of that raising a few concerns, it seems, at the moment. But as you can see, you've got airline stocks down really sharply. I was wondering why EasyJet was down by 4.5%. So EasyJet has a holiday model as well. So it's not the kind of the pure play kind of more airline story that Ryanair is. So Ryanair is down by 2.75. EasyJet, though, is down by 4.5, as is TUI, which are the kind of more closer comparisons with Jet2. But Jet2 is halted and down by 17.5%, Tom. OK, we'll keep across the story when it comes to the airlines and some of the sell-off that we are seeing in the session today and the catalyst for that. But we're going to go macro and go back to monetary policy after the break, because Bank of England Governor Andrew Bailey has played down the importance of a surge in long-dated yields. I'm going to tell you why. That is coming up next. This is Bloomberg. Welcome back. 17 minutes into the Thursday session, and as you can see, we've got a lot of activity out there. We don't at an index level. I'm joking, of course. We're up by 0.2% across most of the main markets this morning. There are a few areas of weakness. The CAC 40 is down by 0.3%. Not entirely sure that's related to what we're seeing actually with French politics. We do, though, see a little bit of a bid back into equities, a little bit of stability back into the bond market. At the moment, it looks like US futures are broadly positive, but you've got ISM to get through, you've got claims to get through a little bit later on. There's a lot of labour market data coming today and tomorrow, so there's a lot to pay attention to. The story, though, I think is really interesting. There's a number of sort of different currents today, and BYD is one that really stands out to me today. And it hasn't had the biggest effect into Europe. I thought there might be a bigger effect of this kind of BYD story into Europe. That's not turning out to be the case, but the BYD story is interesting. Possibly more of a domestic story, but we'll get Danny Lee shortly on that, because, to your point, they've cut their targets, and significantly so, in terms of sales. So the stock is down about 3% so far in the session. So BYD shares down this morning after reportedly slashing its full-year sales target by almost 20% as intense competition in its home market of China eats into profits. According to Reuters, the world's biggest seller of electric vehicles now plans to deliver 4.6 million units this year. That is down from its previous expectations of 5.5 million. Let's bring in Bloomberg's Asia transport reporter, Danny Lee. Danny, what is driving the decline for BYD then? And should there be concern amongst European automakers that still have skin in the game when it comes to the Chinese market?
Well, the reality is BYD is not going to sell as many cars as it hoped. Almost 1 million units is going to fall short on. And when the market and when analysts have been looking over recent months how BYD has been progressing, it has been increasingly concerned by the lack of growth in its delivery numbers and the ambition that it has, obviously, going global and particularly advancing in parts of Europe. So there has been a struggle in recent months. And so when you look at the stock decline this morning and into the afternoon, it's little surprise, really, that the shares are down only by 3% because the consensus actually is for around 4.5 million deliveries this year for BYD. So it is a bit of a watershed moment for someone who's gone through so much breakneck growth in the EV sector overall. So yeah, I think it's a bit of a reset moment for BYD, who has been facing a lot of regulatory pressure around its aggressive discounting in order to stoke up sales. And so maybe it is a bit of a sigh of relief for competitors. And yeah, this is largely a domestic story, but this does feed into the international picture.
Danny, I'm seeing a few BYDs on the streets of London, but not that many. And I'm wondering kind of if we do see the domestic story in China slowing, if the demand isn't there, if the overcapacity story really is starting to have an effect, whether or not there is the alternative of shipping some of these cars or this capacity overseas. But that looks like it's a struggle at the moment.
Yeah, BYD is selling fewer cars overall internationally, but it is doing a lot better than, say, like last year. So it is increasing its momentum. And so with its factories and being built from places like Brazil to Hungary, it is going to be able to have more of a presence at a different kind of cost base than rather than just importing from China. And so when you look at its presence right now, maybe if that story domestically is weak, the fact that it can then double down on its international push. So when you look at some of the European auto majors who may think this is a bit of a good news story for them, maybe not, because maybe BYD will be able to focus on the higher margin sales internationally, where it has been able to be more effective because of the kind of products it does offer. So it's a bit of a mixed bag here, really, and maybe for the likes of Volkswagen, Mercedes and whatnot, it's not necessarily a good thing that if BYD is failing abroad in China, it could very much double down abroad.
All right, thanks for joining us. That was Bloomberg's Asia transport reporter Danny Lee on the latest out of BYD. I thought it was interesting there. He mentioned that he was surprised the stock is only down 3%, because if you combine that with the fact that Chinese indices were decently in the red overnight due to these regulatory concerns wanting to crack down on the stock rally, maybe you can see that BYD should really be down substantially more. You have CSI 300 down over 1% and HS Tech as well.
And maybe there's a read across later for Tesla as well, because Tesla's performance in China is crucial to that automaker's longer-term plans. They're suffering, of course, in Europe. Sales have been falling in the Chinese market for Tesla. You see the number of registrations they got in India, which is a new market for them, which was pretty pathetic in terms of the numbers that came through. So it's a reminder of the competitive threat. It's a reminder of the fact that the Chinese economy, the foundations are still not there in terms of giving that consumer that kind of optimism to pay more for their vehicles.
It's a classic kind of boom and bust story, isn't it, though? The Chinese have driven the Chinese automakers to deliver this kind of capacity and now don't have the end market ultimately to meet it. And you wonder whether or not this is going to be represented in the AI story as well, where there's kind of notes of caution just kind of coming out of the Chinese government. Not everybody needs to do this. We need to be focused. This shouldn't just be a free-for-all. And I'm wondering whether that is going to be a story that is different, therefore, to what we see in the auto narrative.
Does BYD attract the same retail volumes that Tesla does in the U.S.? That's what I'm thinking.
Well, they've essentially got no market in BYD have no market in the U.S. because of the 100% plus tariffs, but Europe is central to their strategy. And to your point, historically, we've seen this time and time again that there is a pile-in effect in China across certain industries that are suddenly hot. I mean, we saw that with bike sharing, where we had about 100 different companies, and then they effectively all were washed out of the system. So it happens. It's happening with the auto space. There will be some winners, but there are going to be a lot of losses along the way.
Let's talk about what's happening in the gilt market. Gilts are now open. We've obviously seen a huge ride this week in terms of the ups and the downs, in terms of what we've seen in the bond market. A bit more stability may be returning. Bank of England Governor yesterday, Andrew Bailey, downplaying the importance of a surge in long-dated gilts, basically saying he wouldn't exaggerate the significance of 30-year bond yields that we are seeing. And in some ways, you could argue that actually this doesn't have much of an impact. This is what he had to say.
although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps.
Bank of England Governor there talking at the end about kind of what he sees in terms of the interest rate trajectory from here. Kit Rees, editor of Bloomberg Markets Today, is here. So let's kind of sum up what Andrew Bailey had to say yesterday. Downplaying the 30-year, you can understand why, and also kind of downplaying the possibility of an interest rate cut as well.
Yes, so overall the tone has been interpreted as being more cautious, and this is probably confirming the paring back we've seen in bets about further rate cuts going forward in the year. So we had the August rate cut decision. We had this historic deadlock amongst the Monetary Policy Committee members. Yeah. So this was really, we wanted to kind of hear more comments about their thinking, about why certain members voted that way. So it was really interesting how there's a big focus on inflation, especially from some of the more hawkish members, such as Deputy Governor Claire Lombardelli and also from Megan Green. But again, the Bank of England's going to have to weigh this up with worries over growth and also the labour market, which first showed signs of softening, then showed signs of stabilising. There's been issues with data quality. So overall, it's a little bit of a confusing picture. So no wonder there's a bit of caution, but it seems to chime with market thinking now.
Well, in terms of confusion, why would the government plan such a late autumn budget? The date is now November 26th. Why are they delaying it?
It's a great question. So it's a very mixed picture on the growth front, on the economic front. So perhaps they just want to get more of a certain view on what's going on. We've had inflation, which is proving very, very persistent, but then we've had this weakening of the labour market. So it'll be great to kind of see these issues reconciled. We've also got many risk events. We've got Bank of England meetings, inflation data coming up, and so it'll be great to see these kind of risk events being played over. Plus, now that government borrowing costs are a lot higher, there's this kind of issue to contend with. So there's a lot going on, and it'll be interesting to see how it all plays out.
And this is a government, this is a cabinet as well that's contending with the challenge and arguably the distraction, the Deputy Prime Minister, and the focus on Angela Rayner and some unpaid taxes. How much of a political risk is that for the government?
Well, markets don't like uncertainty, so if this escalates or develops in any way, that might be seen playing out in the market. But for now, we haven't really seen a big reaction. Sterling was off a little bit, but yields seem to have been back to where they were pretty much. And trading over the summer was a bit of a lull, FTSE 100 drifting to record highs, so that kind of looks okay. But if we see any further development, we might see more reaction. But for now, it's not a big deal, I'd say.
Great to see you, Kit. Thanks for stopping by to update us. Really appreciate it. Kit Rees, Bloomberg Markets Today editor. Thank you very much indeed. Coming up, as President Trump asked the US Supreme Court to uphold his global tariffs, we're going to talk to Roger Fisk, Senior Advisor at Burberry Communications. That's next. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session. So Guy flagged for us earlier the correlation between the stabilising bond market in the session yesterday and the upside that came through, particularly towards the end of the trade stateside in equities. Those dynamics continue in the session today. Bond markets are stable. You're seeing modest gains of 0.1% across the benchmark here in Europe, building on the upside that we saw yesterday of around 0.6. In Germany, the DAX gaining 33 points. There's a bit of weakness over in France. The CAC 40 is down 0.4%. But here in the UK, despite the challenge around some of the travel and leisure and airline names, currently seeing gains of 0.1% on the FTSE 100. Guy.
It's interesting. I think actually the market now feels like it's definitely holding its breath, waiting for the payroll number. We've got a lot of data coming out of the US a little later on today as well. Don't ignore that. But at the moment, this is a fairly evenly balanced market, highs and lows. You got, well, actually, maybe that's not true. Nearly 400 up, 200 down. In terms of the volume, though, we are very light right now in terms of the internals we're watching at the moment. So maybe the market is just now waiting for maybe the next catalyst. That could be payrolls. It could be the CPI data that comes out next week. It could be today's ISM. Lots of things going on out of the States that we need to be paying attention to. Let's talk about some of the 52-week highs and lows. I've got a 52-week high today. I just want to kind of emphasize. UCB, this is a biotech company, focuses on epilepsy, big momentum trade over the last few weeks. And as you can see, the stock has been on a tear really since the spring of this year. And that momentum continues today. We're up by 26% on the year. And that stock hitting a 52-week high today. So that's what the stock story looks like. Here's Val with all the other news you need to know.
Here's what else you need to know this morning. The Portuguese government has declared a national day of mourning after 15 people died in a tram derailment. Local media say the cable that supports the tram car snapped, sending it crashing into a building. 18 other people were injured in the incident. The tram is often used by tourists for short trips in the streets of central Lisbon, with some 3 million journeys made each year. President Trump's campaign to reshape the Federal Reserve gains ground today with an accelerated Senate confirmation hearing on his nomination of a close advisor to be the governor of the central bank. The Senate Banking Committee's examination of Stephen Miron's appointment will provide a look at how a prominent Republican senators will balance their support for an independent central bank against loyalty to their party leader. Bloomberg will have live coverage of the hearing from 3 p.m. London time. And finally, tech industry leaders are expected to attend an artificial intelligence event hosted by First Lady Melania Trump later today, then join President Trump for an evening reception in the newly renovated Rose Garden. Meta's Mark Zuckerberg, Apple's Tim Cook, and Microsoft's Satya Nadella are among the invitees. Guy?
Let's carry on the conversation around what is happening in Washington. President Trump is asking the Supreme Court now to uphold his global tariffs in a fast-track case that could reshape trade policy, or kind of keep it as it is, to be honest, right now. It follows a federal appeals court decision a few days back that indicated that the president can't impose wide-scale import taxes by invoking a 1977 law designed to address national emergencies. Let's talk about all this and all the other things that seem to be going on in D.C. right now. The list is long. Roger Fisk, Senior Advisor at Burberry Communications and a former aide to President Obama, joining us around the table. Good morning.
Good morning, all. Thank you so much for having me.
It's an absolute pleasure to see you. Let's talk a little bit about where we are with tariff policy right now. As the rest of the world watches what is happening in D.C., there is confusion about whether or not the legal cases against some of the tariffs will be upheld. If you are a European, an Asian, a global representative of a government trying to negotiate with the United States, what do you do with this? What do you think is going to happen next?
Sure, and thank you so much for having me. Before you even get to the confusion created by the case that's gone from the appeals court now to the Supreme Court, there's the confusion of how the administration has even talked about and implemented these tariffs.
Yep.
I believe at this point, most of the tariffs writ large have changed somewhere between 55 and 60 times, in the sense that they're delayed, they're doubled, they're tripled. It's Monday and it's 10%, it's Tuesday and it's 25%, it's Wednesday and it's punted for 90 days. So we come into that with that uncertainty. To get into the legal dynamic regarding the case that's going to go to the Supreme Court is traditionally very reluctant to empower the executive branch beyond the actual language of the law.
Court?
So what I'm really looking at there is Amy Coney Barrett, because I think she's going to become the swing vote, almost the David Souter of this generation.
Yep.
And if you look at how she's sided with the liberal end of the court a couple times, I think where she falls is really going to drive how they decide this.
Once this court case is through, do you expect stability? Should we be expecting more stability? Or do you think the chaos that we're seeing, as you say, continues? Is this just the narrative that we're going to have to live with throughout this administration?
I think once you take the India example for just a moment, which is, you know, the image of Modi and Xi and Putin from just 48 hours ago is really the result of the Prime Minister gently contradicting President Trump's version of his involvement in the India-Pakistan dispute. All of a sudden, once that entered the news cycle, the president elevated the tariffs by another 25% because of being somewhat called out on the global stage. And my point is to say that this is largely capricious and random and personality-driven. So one of the things that I think we all just have to kind of accept and get our arms around is that this administration is not a policy vehicle. There's not a framework or a worldview. It's much more driven by if the president just had a great call with President Sheinbaum, then things are great with Mexico. And if he has an issue with Mark Carney, then all of a sudden it's worse with Canada. It's all circumstantial, in and of the moment, personality driven, as opposed to a more kind of sober policy framework that you would see in a traditional administration.
Roger, with that context and the legal challenges, as you look into 2026, what does the picture look like when it comes to the tariff regime of the Trump administration?
Yeah, I mean, what you're just seeing now is some of the large American businesses, especially the retailers in kind of the family goods space, cradles, strollers, groceries, starting to say that they are no longer going to absorb the cost of the tariffs, which now, from what I saw this morning, are $210 billion that have been accumulated from American importers, American companies, and ultimately American consumers. So the question is when does that start to manifest in costs that families talk about around the kitchen table? And then the second question is to what extent that Democrats can build and deliver and have resonate a cohesive, targeted conversation with the American people around the economics of it and what they intend to do to counter that and bring some of this stability back, to connect your two questions.
So that brings us directly to the domestic political challenges or costs of this. If there are costs for the Trump administration leading up to the midterms next year, what is happening right now? How is it changing the domestic politics of the US right now? Is it doing anything to erode President Trump's popularity? Or is he winning on the argument that this is bringing in revenues?
It's bringing in revenues, but it's bringing in revenues from American companies and ultimately American consumers. So the idea of giving a rebate is kind of the dog biting its tail in a lot of ways. I think, what you're going to see right now is, again, to what extent the cost of this, and there's larger costs around the tariff issue. For example, just this morning, I saw news around the soybean farmers in the Midwest of the United States, Nebraska and Oklahoma, who normally would have a full ledger of orders from China that would be 10 to 15% of their product every year, and there are 0 orders from China.
But does that put the wind in the sails of the Democrats in the midterms?
It puts wind, and it's the Democrats' job to get it in their sails.
That's a good analogy. I do want to take this tariff conversation a bit more long term. Let's say the Republicans lose the next presidential election and we get a Democrat in the seat. Will he repeal the tariffs? Because Biden let those China tariffs that Trump 1.0 put in. They're a really hard thing to repeal, especially once you start gaining revenue from them. How do you think the next administration, if there is a change of party, will deal with it?
Well, again, and I appreciate the question. The premise of calling it revenue is really a circular dollar that goes from Americans into this tariff pot. I can't imagine that a Democratic president would maintain this. One of the things that is so surprising to me, because the president bases all of this on this idea of the trade deficit, is that if you're the largest economy in the world, it's going to be very difficult to find a country somewhere in the world that you're not buying more from than they are from you, right? So in that sense, I think any Democrat or even another Republican would want to come in and actually calm this down and put it in a larger policy framework for no other reason than just one example, which is this. If we're going to talk about repatriation of manufacturing jobs, then part of that has to be about skills and bringing coding skills and robotics and AI skills to the American workforce. There's 0 conversation about that from this administration, which gets to my earlier point that it's not a full, robust policy conversation, because if it was really about repatriating jobs, there'd be a whole conversation around skills and education to the next generation of the American worker, and that's not happening.
Well, what do you think this policy is really about then?
I think that the president thinks in very blunt terms, and in a lot of the large issues, he gravitates towards very blunt, simple solutions. So if you talk about immigration, it's one word and it's wall. And if you talk about trade, it's one word and it's tariffs. And there's some comfort in that simplicity. But as we all know, just from listening to your programs as often as I do, simplicity is an illusion in any one of these matters. For example, with the trade deals, there is to just announce a trade deal with a country is not really a trade deal in and of itself, because what really creates the structure and the traction for a trade deal to really mean something is very detailed language around things like transparency, verification, remedy, enforcement, all of those things. Most trade deals take 1 or 2 or even 3 years to actually turn into a 2,000-page document. And that's also another example of where we're just not seeing that policy component from this administration, leaving it much more personality-driven.
Well, we certainly see the Europeans and the British as well trying to nail the jelly to the wall on some of the trade deals that they've struck with Washington. Fantastic analysis on what is happening in terms of the thinking within Washington, particularly around the trade story. Roger Fisk, senior advisor at Burberry Communications, former advisor to President Barack Obama.
OK, let's turn attention to what is happening in Portugal. We will get you an update next as to what has happened overnight. The Portuguese government declaring a national emergency. 15 people have died in a funicular derailment in Lisbon. We'll have the details for you next. This is Bloomberg. Thursday, the 4th of September, 45 minutes past the hour. The Portuguese government has declared a national day of mourning after 15 people died in a tram funicular derailment in Lisbon. Local media say the cable that supports the tram car snapped, sending it crashing into a building. Let's get an update as to what we know and what happens next. Enrique Almeida is in Lisbon for us. What do we know about what happened?
Well, good morning. So far what we know is that the cable that supports the tram snapped as the tram was coming down one of Lisbon's hills, and it crashed into a building further down that hill. 15 people have died. Initial reports said 3 people had died, and then we got an update later in the evening saying that 15 people have died and now 23 people are injured, some in serious conditions. So we expect to get more updates about who the victims from this crash are, but most likely there will be tourists that were visiting Lisbon at the end of the summer season here in Lisbon.
Enrique, what is the government saying about this tragedy at this point?
Well, the government has offered its condolences, of course. It declared a day of mourning, and it said it will try to answer all the questions that have been raised about the possible infrastructure problems that affected this accident. The government has also suspended all the other trams that are running across Lisbon, and an inquiry is currently taking place to figure out what went wrong here.
OK, Bloomberg's Enrique Almeida on the latest out of Lisbon. Enrique, thank you. Switching focus now, European leaders are expressing concern that Russia will mount a new offensive on Ukraine as they discuss security guarantees for the country with President Volodymyr Zelensky. This as Russian President Vladimir Putin says Zelensky should meet him in Moscow. Our Europe correspondent Oliver Crook has the latest. Ollie, talk us through what to expect then from the meeting today. Is anything that's going to come out today actually going to move the needle for Ukraine?
Well, that will really all depend on Donald Trump and whether or not they can convince to get Donald Trump a bit more on the side of the Europeans, which, of course, has been the great effort for the last few months, is to try to get Donald Trump to see things as the Europeans do. For this meeting, the Coalition of the Willing, just a reminder, is the broad European format. It's chaired by Keir Starmer and Emmanuel Macron in Paris. And here they really have two ambitions. One is to talk to Donald Trump and to talk about possibly putting more pressure on the Russians to try to get them to the negotiating table, maybe getting on board further with those secondary sanctions. We've already got sort of phase one of that is what Trump suggested is what we're looking at right now with those 50% tariffs on India, and that could ramp up. But the second part of this is, of course, this question of security guarantees and the coalition of the willing. What we don't have the answer to is the question of what are they willing to do? What does this coalition look like? What does a reassurance force look like in Ukraine the day after peace? That is going to be some of the details that they're continuing to work out. And we should say that that is not a very sort of easy question to answer. We should also say that it's an irrelevant question position until there is peace in Ukraine. And judging from the last couple of weeks where we've seen massive drone attacks, missile attacks by the Russians, now reports that you have actually more Russian troops massing on the part of the Donbass, that they don't collect 100,000 troops that are apparently now aligning to the border there, according to Zelensky. Will this eventually convince Trump that Putin is actually just playing for time, as the Europeans said from the beginning, to say nothing of the last 72 hours, where we've seen basically, though Russia's position on the war hasn't changed, Russia's position in the world certainly has. Whether he's holding hands with Modi, he's sort of embracing with Kim Jong-un. This is a different calculus for Vladimir Putin, and that is all for Donald Trump to interpret and trying to figure out how to respond to that.
Ollie, are there questions in France about whether or not Emmanuel Macron should be focusing on this or focusing on what is happening domestically and the problems that the government in France currently faces?
Yeah, I think it's a completely valid question, Guy, and it's one that I don't think anyone's asking, to a great deal at the moment because they're so distracted by the political drama that is going on within France. But let me just sort of set the scene for you here. This is a meeting that is chaired by Keir Starmer and Emmanuel Macron. Are these leaders that are in particularly strong positions in their nations? I would say certainly not. Certainly not Emmanuel Macron. He's about to have his government collapse yet again, probably on Monday. And the question is, at what point is France in a position to make these guarantees, particularly if, and again, this is going a little bit further down the line, you have to have other snap election. The biggest party in France is the Rassemblement National, Le Pen's party, and they are very sort of skeptical of Ukrainian support. Are they going to get on board with an idea of putting French troops, potentially as peacekeeping troops, within Ukraine? These are questions that I don't think are self-evident, and this is something that is still sort of moving forward. I think the UK support, no matter where you are on the political spectrum, is a little bit more secure than it is in France. But again, there's a big question about what the future of French politics looks like and whether or not Emmanuel Macron is really in a position to be making these very bold guarantees.
Ollie, I want to focus in on that last point there, that the fact that we might have the French government falling apart next Monday on this no confidence vote. How long until we could get a French budget passed that could have some of these promises they've made to Ukraine in it?
I think the problem is that no one can answer that question. I mean, you look at the polling, even if they did call another sort of legislative election after the collapse of the government, which will be presumably happen next week, the polls are basically unchanged. You have this story that we've seen all over Europe, whether it's in the Netherlands, whether it's in Germany, whether it's in so many countries within Europe, total political fragmentation. And right now, no matter who you talk to, you listen to French radio. I was in France last week, you speak to people, no one sees how this can get resolved. Will Macron try to tack to the left? That won't even be enough necessarily to get him a majority to be able to do what he wants to do. So there are just these sort of unanswerable questions at a moment when, Val, you're looking at the budget deficits within France and the amount of debt that they're collecting. This is really going to come to a head at a certain point, but at the moment there is really no through path. So we're going to have to see if they can pull anything out over the next couple of days. I think it is all but assured that the government was going to fall. I mean, you watch the interviews that there have been on French media over the last couple of days with the Prime Minister. They all begin with, so, how do you feel about your last few days in office? He tries to put on a brave face, but it's not really that convincing.
Yeah, interesting stuff. Ollie, thank you very much indeed. Ollie's going to have a busy week next week. We'll certainly be covering this as we get into the beginning of next week, Monday. Obviously, a key date for your diary. Talking about key dates for your diary, what are we watching for the rest of the day?
9:50 a.m. Talking of French politics, an 11 billion euro French bond auction. French bonds right now being well behaved. In fact, yields are down about 1 basis point. So we'll watch that bond auction, see how well received or not it is, in about an hour's time. At 1:15 p.m. UK time, we're going to get US ADP employment data. So building out the picture from Gilts that came in, of course, job openings shrinking more than expected yesterday. At 1:30 p.m. UK time, US additional jobless claims staying on the labour market of the US. And at 3 p.m, it's the US ISM Services Index. That's dropping at 3 p.m. And later, Stephen Myron, Senate confirmation hearing, of course. No senators from the Republican side yet have come out to say they're going to attempt to derail this. And, of course, they're trying to get him in place before that September the 17th decision from the Fed, where they are now expected by the markets to cut.
Yeah, that's right. And he has also released a statement ahead of the hearing, really backing Fed independence. So it does seem like he's going to toe the line that he thinks the Senate is going to want to hear. But elsewhere, gilts, bunds and OATs are all trading higher across the curve as calm returns to the European bond market. Here's what BTV guests have had to say on the extraordinary price action in the bond market this week.
We know that the prevailing narratives don't make sense, right? This is not about public sector debt levels. This is about investor behavior and investor psychology.
Well, that is part of the narrative clearly here in the UK.
Yeah.
I don't think it's contagion. I think it is incidentally really in global bond markets sort of several idiosyncratic factors that are meeting at the same time.
The situation in the UK is quite dangerous at the moment because of the return of the bond vigilantes.
Yeah, I try to not predict the triggers, right? I try to look at, what is the signal rather than the noise. And the signal is quite clear that there is still, at these levels, no appetite for the long end.
I would have a reasonably high degree of confidence if you could fast forward 3 or 6 months. You'll probably make a lot of money in these bond markets.
I don't think people are massively going to flock into US Treasuries now, because that either would be really only happening if we did see really some significant deterioration in the data, that's number one, or if we saw some proper risk-off.
We were told for most of the last 10 years that these were safety assets. What's really going on here is people were buying these hand over fist when yields were 0, when yields were 1. And they are sitting on huge capital losses. There's a huge risk premium, because we're pricing the past.
A lot of hot takes on the moves in the bond markets this week from guests sitting around the table. Is it over for now? It might be all down to the data. We get more labor market. Today. It was the weak Gilts data that really added the calm into the Treasury market yesterday. Today with ADP, jobless claims, ISM services, and tomorrow, payrolls.
Are we going to watch? What are we going to? I wonder where the surprise comes from. Does it come? Is prices paid in the ISM a number you want to look at? Are we pretty much locked in on what we think the labour market is doing? Does the surprise now come from inflation? Where does the surprise come? The market feels convinced that 25 basis points is locked in for September. Kind of what? Is there anything that knocks us off course on that? Pooja Kumar was here talking about the fact that it's certain, it is definitive, that is going to happen. Is it?
And Pooja Kumar is making the case for 2 more cuts beyond September.
Yeah.
And that brings us back to the inflation story, because if you look at what's happening coming through in the Fed Beige Book, and if you get that price pressure coming through and the ISM data later today, and the fact that those inventories have been drawn down, basically, if you get a more inflationary environment in the US, and there are some indications that that will happen towards the end of this year, how can you justify going beyond September? Are we September and done? And then what is the bond market reaction? Where we speak to our guests, and consensus trade seems to be buy the front end, steer clear of the long end. Does that still be the trade in that environment?
Well, it might be down to what we hear from these potential Fed chair candidates. We know, reporter from the Wall Street Journal, those interviews start with Scott Bessent on Friday. Perhaps they make a lot of noise, pushing the Trump agenda, saying it's deflationary, saying that any inflationary bump is just a speed bump in the road, and we should continue to cut. Exactly.
Is the market going to look at that and go, no, we'll do what we want to do at the front end, but the back end, that's where the fear starts to come in. That's it for the opening trade. Tomorrow's payroll day. We're done for the day. The Pulse is up next. Hope you enjoyed the show. We'll see you tomorrow. This week's not done just yet. This is Bloomberg.